Hello, everybody. So today I want to talk about Rivian. It's a stock that has been in the news all day today because it's down 22% after it did a convertible bond that they nicely call green bond. And Rivian has a lot of marketing about the environment and about the fact that they're green bonds. But I don't think it really helps them out that much. These are expensive bonds, especially if you want to borrow debt right now, if you want to get some debt right now in 2023 with the current interest rates. It's kind of scary. And in my view, it's even scarier that they had $1.3 billion again in a convertible green bond. Again, they had that in March 2023. And now today, we know it's $1.5 billion. So this stock is $2.7 billion in debt extra, right, in a matter of 6 months. And that is a company that is roughly burning $1 billion in cash per quarter. This is per quarter, and actually, it's a little more when I look at prior quarters. They've done quarters where they've burned 1.3 million, 1.3 million. I wish no 1.3 billion in cash, and this is a company that has a balance sheet with 10.2 billion in cash. Keep in mind, it's not net cash. There's debt attached to that cash. That cash has been borrowed, much of it actually, not all, but much of it, and even if you look at the cash, how much they're burning, you can see that this is a company that has 2 years and a half of runway. But that's assuming the current losses stay the same. But they have a problem. The problem is that they have negative gross margin. So as this company grows, they're digging a bigger hole from themselves. And I think it's reasonable to assume that they're going to grow at about 100% a year for a few years. When I look at the numbers, when I look at what they've done, I think that they do 100% next year is more than reasonable, right? Because they're going from such a small base. The problem is that this only accelerates their losses, and they say that they want to reach positive gross margin in 2024, but don't forget we have tremendous operating expenses, tremendous capital expenses for expenditures for this investment. We have tremendous investment because this is a company that's investing in its products. This is a company that's working on an R2 product that costs a lot of money, and they're ramping all of these factories. So there's no guarantee that the negative gross margins are not going to get even more negative, right? And even if they stabilize, they would have a very, very long way to go before they stabilize, because I'll show you how much they lose per car, how much they lost per car last quarter, and you'll see, I think it's a little scary. Currently, Rivian has two cars and one Amazon truck. They only sell the truck to Amazon. Amazon made a big investment in them. So they have these 3 vehicles right now. That is what they sell. And these vehicles, by the way, have been largely reviewed as excellent, absolutely excellent vehicles by most of the press. They've been very well received. And in my view, I've seen them a few times in my area. All 3 of these I've seen in my area. And they look like the future. I mean, they are vehicles who look nothing like a F-150 or a Chevy Suburban, if I were to compare these 2 vehicles. They really do look like the future. I also want to say that I think they have a marketing very similar to Jeep. I think if this company succeeds, they could hurt Jeep perhaps much more than, say, Ford and the F-150 Lightning. But anyways, these are the products that they make. These 3 vehicles, one of them commercial, 2 of them for what I'm going to say call adventurers, for adventure, leisure type of truck. But I'm lost. I'm blind with this company because I can't use my regular spreadsheet, and that's why I don't invest in either pre-revenue company. I hope, and I generally don't consider even negative gross margin company, but having a negative gross margin is even worse than being a no revenue company, in my view. A no revenue company, you don't have to worry about scaling hurting you. When you have negative gross margins, i.e. when it costs you much more in variable costs to make that product than you even get back in money from revenue from the sales, it's a scary situation. The latest quarter, they delivered 12,640 vehicles. You can see they sell the vehicles that they make, and I generally believe most electric vehicles are going to get sold because they are so compelling in general. But they made 412 million in negative gross profit. So this means that they've lost $32,000 per delivery. So imagine if they double that. Imagine you're digging a bigger hole for yourself. If 4 quarters from now they have double that and they haven't worked on their negative gross margin, they'll be at 800 million in negative gross profit. And you add that to what they already spend in OPEX and CAPEX. So growth for them is kind of digging a bigger hole. And I would argue in general that this would not be a problem in a regular Fed environment, in the Fed environment that we had prior, right? Where we didn't have a 20-fold increase in interest rates. Like these type of finance companies can get finance in cheap debt environments, in very, very cheap debt environments. I also wanted to be a little creative, and I thought this was very interesting because when I looked at the number, it got me thinking, what if I try to value this company on a market cap over what I'm going to say price for the capacity of one vehicle? So it's simply dividing market cap per cars produced, and I'm using each vehicle as a proxy for the capacity of the plants. It's worth noting that even on that metric, Rivian is actually fairly expensive. You have $455,000 of market cap per vehicle produced, per one vehicle per year capacity, 455,000, and Tesla is actually cheaper than that at 448. Of course, it's not directly comparable because Tesla actually makes money and actually can scale profitably, or at least they can scale without digging a bigger hole for themselves. And what hurts Rivian even more, in my view, is the fact that yes, they are investing heavily in their next vehicle and they're diversifying. And you'll see why. Competition is coming for trucks. That's why they're diversifying. And so they're working on developing this vehicle, an SUV-type vehicle, maybe would compete against the Model Y. But that's 2026. That's 2 big years out, right? Depending on how you look, depending on when in 2026 could be as much as 3 years out. So remember, if it's 3 years out, like I'm calculating, this is a company with a 2.5 years of runway, assuming they don't dig a bigger hole from themselves by scaling and upselling and selling more vehicles, right? And so this is a company that is struggling, in my view, and that I would not own. I would not touch this company with a 10-foot pole. I would not own this company as much as these products have been praised by commentators. These products have been heavily praised, but I would not touch it. I may be interested in this company in a low rate environment, but in this rate environment, there's no way, right? We're not thinking about raising rates and 0% rates until 2024, late 24, early 25. This is a company that could have gotten much more financing for cheap and could have afforded to go past that J-curve, which kind of represents the manufacturing hell that Elon Musk talks about, that J-curve, where as you scale, you dig your losses get bigger, right? It's worse than just having a lot of operating expenses. It's much worse. You're losing more money, right? You're not covering your variable costs. Today, interest rates are hurting Rivian. And I'm afraid that because this is convertible debt, not only do you pay more for that debt, but you may get that debt converted into the stock. And in this case, we would be talking about major dilution of the shareholders, enough for me to care. And you know that on this channel, I typically don't mind dilution. I am not one to mind what most investors would consider very large levels of dilution. But in the case of all of that debt that would get converted, it would be too much. You would entirely take away the ownership. Well, not entirely, but tremendously. So again, this is something you may want to look into the data a little more. Because that's a lot of money, 2.7 billion in 6 months. They borrowed 2.7 billion in 6 months that could be converted into stock. Imagine if they borrow another 2.7 billion over the next 6 months again. And I would stay away because of a major concern. If they have a shot, they also have a problem coming, which is what I'm going to name the Tesla coup de grace, is what I'm going to name it, which is the whole idea. But this is a struggling company. They're losing a lot of money. Cash flow, negative cash flow. Like, this is not just losing money from a GAAP standpoint. This is losing money with negative cash flow. But they also have this coming, a competition. And let's not forget that the Cybertruck has been marketed to a whole bunch of people, but it has also been marketed to the adventure folks, right? There will be add-ons. There will be different features that you can add to the Cybertruck to target it towards adventure-savvy buyers. So this is a company who will be directly competing against a Cybertruck, period, against the Cybertruck. And so we don't know yet about the Cybertruck, but I anticipate this stock to clearly be hurt when the Cybertruck gets released. At least that is my view. So this was not investment advice. This is just entertainment, clearly, and I hope it was entertaining, but just entertainment. Feeling bad for Rivian, that interest rate environment could have helped them when they IPO'd, and this is what we see for so many innovative companies. It really sucks for those engineers and all of those people working very hard, but that's just the way it is. I appreciate your likes, appreciate your subscribes, and have a wonderful, wonderful day.